So welcome back. Today, I want to talk about types of market analysis. So basically, we've got three types of market analysis. So when one becomes a trader or needs to be a trader, it means they need to be good in all the three types of market analysis. So we've got three basic types of market analysis. We've got the technical analysis, we've got the fundamental analysis, then we've got the sentimental analysis. So the technical analysis, it is the use of charts, patterns, being able to study the charts and the chart patterns and the structures and the patterns that are created by the market. So this technique is used to predict future price movement. So it is based on a trader's analysis of historical price movements and his projections on future moves. So it is done on a trading platform, which allows one to study the charts in order to make trading decisions. So when you do a technical analysis, you come to a trading platform which shows all historical data and all the current data on a chart. So being able to study the movement and the patterns and the structures that are created by the market as it moves, you're able to predict future price movements just by studying those structures. Because when the market moves, they leave what we call like blueprint type of movements or blueprint type of structures. And when a certain structure appears, it entails a behavior that is happening in the market, and it entails what is likely to happen to a market if a certain structure is formed by the market. So that is the technical part, being able to come to the technical graphs and study them and make future price predictions. Then we've got the fundamental analysis. This makes use of all the available data to help determine the relative market value. So the fundamental analysis, we are paying attention to the economic news, releases, we are paying to economic data to predict where the market is likely to go. So the value of any foreign currency in its simplest explanation is the reflection of a country's economy with respect to other major economies, which gives signs of where the value of the country's currency is headed. So for example, of the United States, if United States releases its inflation data and there's an increase in inflation in America, we can expect the dollar to lose its value against any other currency that it is being traded against. Or if the inflation decreases, you expect the dollar to strengthen. So on the economic calendar, there are days and dates that are already set in which different countries, they announce different fundamental news. For example, there is interest rate decision, there is employment change, there is unemployment change, there is inflation release, then there is also employment change, and etc. and etc. All these things, they affect a country's currency, because when this news is given out or is being released, we know if the news is negative on a certain currency, it's going to affect that currency in a negative way. And we expect the currency to depreciate. And if the news is positive, we expect that currency also to appreciate value against any other currency that it is being exchanged for. So this is the fundamental analysis of the market. But when it comes to fundamental analysis, there's a lot of propaganda in which the market can decide to move even against what the news or the fundamentals are actually saying, but this is a more advanced way of understanding the market, which actually entails you what is likely to happen to the market even before the news release. And when the time the news comes, as the news just comes to complete the setup that is already set or done by the market. Then we've got the sentimental analysis. So sentimental indicators show the percentage or raw data of how many traders or trades have taken a particular position in a currency pair. For example, let's assume there are 100 traders trading a currency pair. If 60 of them are long and 40 of them are short, then 60% of the traders, they are buying on a certain currency pair and 40% are selling on a currency pair. And we know, since we are in a market, if the market have too many buyers than sellers, there's a certain way we expect the market to behave. And if the market have got too many sellers than buyers, we also expect the market to move in a certain way or behave in a certain way. But for it to be called a market, it means it contains both the buyers and the sellers. And if there are more buyers than sellers, there's a certain reaction the market will take. And if there are many sellers than buyers, there's a certain reaction the market also is likely to take. So when the percentage of the trades or the traders in one position reaches an extreme level, sentiment indicators become very useful to actually determine where the market is likely to go. So sentiment indicates it is time to begin watching for a price reversal or not. So when the price moves lower or shows a signal, it has stepped the signal, the sentiment trader enters short, assuming that those who are long will need to sell in order to avoid further losses as the price falls. So when one becomes a trader, you need to be good in all the three ways of understanding and studying the market. You need to be good at the technical analysis, good at the fundamentals, and in understanding the fundamentals, and also good in understanding the sentimental analysis. So we are going to teach you all the three methods of understanding and analyzing the markets using all the three methods. So moving on, we've got three types of market charts. We've got bar charts, we've got line charts, and we've got candlestick charts. All these are graphical means or graphical representations of market movements or the movement that takes place in the market. But we use mostly what we call the candlestick charts. So what is a candlestick? A candlestick is a type of price chart used that displays the high price, the lowest price, the opening price, and the closing price of a security for a specific period. It is originated from Japanese rice merchants and traders to track market prices and daily momentum hundreds of years before becoming popularized in the United States. So the white part of the candlestick is called the real body, and it tells the investor or the trader where the closing price was higher or lower than the opening price. So red and black are the colors that we use when it comes to candlesticks. And different candlestick colors, they tell us if one is a bullish candle or if one is a bearish candle. So a candlestick chart is also called a Japanese candlestick chart. It is also a style of chart used to describe price movements of a security, a derivative, or a currency. So the candlestick components. So just like a bar chart, a daily candlestick chart or a daily candlestick shows the market open, high, low, and close price for the day. The candlestick has a white part, which is called the real body. This real body represents the price range between the open and the close of that day's trading. When the real body is filled in or black, it means the close was lower than the open. If the body is empty, it means the close was higher than the open. So we've got two types of candles. We've got a bullish candle and a bearish candle. So a bullish candle is a candle which shows a movement of price to the upside. A bearish candle, it shows the movement of price to the downside. So when a bullish candle, when the close is higher than the open, usually a green or a white bearish candle. When the close is lower than the open, usually red or black, bullish and bearish candlestick chart patterns. There are three main parts to a candlestick: the upper shadow, the vertical line between the high of the day and the close, the bullish candle or open, the bearish candle, the real body. The difference between the open and the close, colored portion of the candlestick, lower shadow, the vertical line between the low of the day and the open bullish candle or close that is on the bearish candle. So these are the type of candlestick patterns. So explaining what we had, we are saying that if it is a bullish candle, it is usually green. It is usually colored in green, and it is a green candle, which shows that price opened at a certain price level and it closed at a certain price level at a certain period of time. So this is the highest price, like the high that was reached before that candle closed. This is the lowest price, the low that was reached before that candle closed. So we either call them wicks or shadows. Either call them wicks or shadows. And I said a bullish candle is one which shows a movement to the upside, and it is green. And if the movement is to the upside, it means price starts below and it closes above. So let's assume it's a euro US dollar pair. If the price moves from 109.50 and goes to closes at 1.9, 1.09, 1.0960. It means by looking at the candlestick, I'm able to tell how far the currency pair have moved in a certain time, because by looking at the candlestick, it gives me all the data of what has happened to the market. And the highest price, it will be the price the asset or the currency would have moved to before it closes. So the market can move up to 1.0970, but when it closes below, because each and every candlestick have got a time frame of opening and closing. So if, for example, we are on a 1 hour chart, it means all the candlesticks that we will see on the chart, they represent 1 hour, which means each and every hour, a new candlestick opens, and after its 1 hour period is done, it closes. So by just looking at a candle, I'm able to tell the price movement that have taken place in an hour, to actually see, oh, in the past 1 hour, price got to 1.0970, but when it closed after its time was up, it then closed at 1.0960, and I can also track where it opened, and I can see that in the past 1 hour the market was bullish, or the market was buying, because it went all from 1.0950 to 1.0960. The opposite is true for a bearish candle. It is red in color, which means this will be the open price where it starts, and this will be the closing price. This is the lowest price, which means it reached a certain low, but when it closed, when its time was complete, it closed above. Or even if it opened there, there's a certain point in which it went up to this price, then it went down. So by looking at the candlestick, you are able to tell a price movement that have taken place in a certain period of time. That's why we use the candlesticks, because their presentation of data is quite understood, and it is easier to interpret. And also, the other reason why we use candlestick charts is because with candlestick charts, they entail a very large detail as far as what's happening in the market in terms of behavior. When the market moves, it presents itself with different candlestick patterns, and there are certain candlestick patterns that actually entail what is likely to happen to the market. They are what we call candlestick reversal patterns, which means if the market is about to reverse, there are certain candlesticks that are seen forming, which tells you that the market is about to reverse. So with the help of the candlestick, they also add as extra confirmations to where the market is likely to go, which is also supported by the market structures and the patterns that will be created that also help you to tell where the market is likely to go. And with the addition of the candlestick patterns that will be formed, they also give a more detailed explanation, and they also give a more support to what is likely happen to the market. So once you study the market structures and the market patterns, you can also get extra confirmations from the candlestick patterns of what is happening in the market and how the market is likely to behave. That's why we use candlestick patterns. So moving on, we want to talk about support and resistance. So when the market moves, they create what we call support and resistance area. So a resistance is a price level. A resistance is a price level where falling or where rising prices, where rising price stop, which means it faces rejection, change direction, and begin to fall. So a price resistance is often viewed as a ceiling. So let's take, for example, you are bouncing a tennis ball. If it reaches the ceiling, it bounces off the ceiling going down. So a resistance is a price level where rising price stops and changes direction and begins to fall. So that's generally a resistance price, and a support is a price level where a falling price stops, change direction, and begin to rise. So a support and resistance in the market, they are like trading floor and trading ceiling, whereby if price reaches the ceiling, it rejects and starts to go down. And when price reaches the floor, it rejects and starts to go up. So in a way, we're just saying that we've got a resistance and we've got a support. So these support and resistance areas, they are created by previously historic data in which each time price used to get there, there is a rejection of price to the downside. So if a rise in price reaches a resistance, it goes down. And if falling price reaches a support, it goes up. So that's the basic of support and resistance. This is the basics of support and resistance, of how the market usually behaves when it reaches a resistance based on previous historic data, where the price area whereby each time price gets there, it rejects and starts to goes down, or a support level where price, each time it gets there, it starts to go up. So that's the basics of support and resistance. So just like in this example here, we have a resistance in which price, when it gets there, in a rising price, it starts to go down. Here it becomes a support, because when price gets to that price level, it always rejects, starts to go up. That price level, it always rejects and starts to go up. So we call that a support. And an area where price, when it gets there, it rejects, starts to go down, rejects, starts to go down, rejects, starts to go down, rejects, starts to go down. We call those resistive areas, and others are supportive areas. So you don't only trade based on support and resistance. Support and resistance are retail trader type of trading or a trading style. So for more advanced trading knowledge on how actually the market moves and how to anticipate the real market direction based on the market maker method, which is the method which was developed by an ex-market maker. A market maker simply refers to a person who controls the market because they've got a huge equity base and they've got a big influence in the market. So with the market maker method, we are able to know the behavior of what's happening in the market and what is likely to happen in the market based on the market maker strategy, which helps you trade in line with the market maker or trade in line with the person who controls the market. So some perceived support is not really support, and some perceived resistance is not really resistance. But when the market moves, they need to validate support areas and resistance areas, because almost every retail trader trades based on support and resistance. If price reaches a support, everyone looks to buy. And when price reaches a resistance, everyone looks to sell. So for more advanced trading knowledge, which we offer, kindly visit our website www.forexplugs.com and find out more about our training packages, about the market maker method trading strategy, a strategy which is an advanced trading method which was developed by an ex-banker or an ex-market maker as a way of helping traders to trade in line with the market maker or trade in line with the banks or trade like the person who controls the market. So that brings us to the end of the introduction to Forex trading. For more advanced classes, kindly visit our website. Thank you.